Okay, so up next is our industry professional. She started out with SMA Consulting, earned a bachelor's degree in accounting, and continue learning about the building industry and management accounting from some of the most respected names in the building industry. She started at the bottom, but worked her way up to senior financial analyst, and now is the proud owner of Green Accounting Team. So please help me welcome Angela Green. Good morning, Angela.
Good morning, David.
Thanks. So I have a lot of questions for you, and I kind of know some answers on a few of them, but I just really wanted to get the facts so that our audience knows exactly what's going on in reference to taxes and real estate. So a couple of facts first that I just want to throw out there. The most everyone knows, of course, that real estate is probably the largest financial investment and transaction that a family will ever make. And actually 80% of retirement savings comes from real estate for most people in America. The average national average appreciation of real property is 3 to 5%. Depends on where it is. If it's a coastal area, generally it's higher. Inland is perhaps right in that 3 to 5. But that really outlines the fact that real estate is huge money, and there might be a way to take advantage of it. So knowing what the tax advantages and pitfalls are probably really beneficial to our audience. So first question, is it worth buying a home for tax purposes, Angela?
Absolutely, it is. And the huge benefit of that is that if you're just renting a property, you're paying the rent, but you're not gaining anything from it. You don't have anything to show after you make your monthly rental payment. There's nothing to show for it. You have no ownership.
Mm-hmm.
So the best reason, I mean, obviously having a home, you're sitting there, you're just showing everybody you can do what you want with the home. You can decorate it how you want, make the changes that you want. One of the big things is that you can write off a good part of your mortgage payment because most of it is going to interest and not principal at first. So yeah, it's definitely, there's a big advantage to having your own home.
Gotcha. And is there any kind of an average of or piece of the payment? Because you have principal, interest, tax, insurance, perhaps association dues, maybe some Mello-Roos, which is an additional tax. Is there any of those that you can really identify that, yes, that you can write off, that you cannot?
Yeah, there is. So the interest on the home mortgage itself, including most of so if you have to get a second mortgage or if you have to get mortgage insurance on the property, those are all tax deductible. And also the property taxes are included usually in your escrow payment. So if you've ever looked at your mortgage statement, very little of that goes to the principal. So then a great part of that you are able to write off. Now, when Trump has the new tax changes that happened a couple of years ago, what they did with those changes is they added a cap on the amount that you can write off for sales tax, property tax, and that in itself is huge. It's called, I mean, you'll hear the SALT deduction. So that in itself is a 10% max. So when you live in California, you have, property taxes are huge, sales tax is huge, and you have that cap of $10,000. So you can write those off. The other part of that is the interest on the property, and you can that doesn't have a maximum on it. And part of this conversation also needs to be, if you have to have more, there's an amount that you'll start to spend. So if you spend over a certain amount, you can itemize on your taxes. And we need to understand what itemization means versus a standard deduction. And many, many people do not understand.
Yeah, so So I'm supposing that, some weird noise there. So I'm supposing that must depend on how much you earn, whether you're married, have dependents,
Right.
all those kinds of things, right? And so,
Right. So every person, so if you're single, then automatically you can write off $12,200. If you rent or if you have a mortgage, that's your minimum that you can write off. Standard deduction. When you're married, that's double. So it's 24,400. And then you have head of household, and that's a little more. It's 18,000 for and some change, like 18,350 for head of household. So if you are a married couple trying to write off your home and your home mortgage, which is your property taxes and your interest for the home, then you need to have expenses more than the $24,400. And where we get that when we itemize on our taxes is you can write, if you are able to achieve that, is $10,000 for sales tax, property taxes, so the price of your vehicle, excuse me, your let's see, sales tax, property taxes. So property taxes are huge, and a lot of my clients have more property taxes and sales tax than the $10,000 max. So if you have $12,000, it doesn't matter, you still get 10,000. So you can write off part of your medical expenses, healthcare expenses. That adds up to this. You have your taxes that we just talked about. You have your home interest, and then there's some miscellaneous things that you can include in there. So with all of those, if you are just buying a house and you are married, it's going to help you. It's going to save you a lot of money because you're going to spend more than $24,000 on rent and on, you can write off your charitable contributions at that point and, your health care. So that's when it really starts to benefit you when you're even single. If you're single and you're able to purchase your own home, then it's going to benefit you also because you have the same things that you can write off at that point, but you just have to achieve a lower amount. So for single, it's $12,200. Anything above that, and it's really benefiting you to have the house.
mhm. Yeah, interesting. That's talking about owner-occupied property. So what if they already have an owner-occupied property and they obviously are benefiting from it? But they're thinking, perhaps I should buy a second home or maybe an investment property. Are the write-offs different on those?
No, so if you have a second home and you are not renting it out, there are a lot of people who have vacation homes and they don't, they just have family members living there. They don't really collect rent on them.
Right.
So it's the same thing, is you're still able to write those off. But again, in California, with property taxes so high on two homes, you're going to reach that $10,000 very quick, our limit of $10,000 that you can write off for taxes. So if you were able to have the two homes, it's really going to benefit you to turn one of those into an investment property, and then just in that aspect, you can write off all the property taxes as part of an expense for that property. So
Uh-huh.
you're not limited on that part of it.
Right. Gotcha. So if you have an owner-occupied property and a second home, you're still limited to the 10,000, not per property, but per tax return per
For
individual.
your tax return.
Yeah.
Exactly.
Yeah, much better yeah. So that all second homes are now
Yeah.
investment properties.
Exactly. They should be. And, at some point, if you have more than one property, I think we really need to start talking about if you're going to have more than one investment, then you need to have another company, have a company, have an LLC or an S-corp, depending on how many properties you have in the states that they're in. So California is very expensive to own anything. So I have a lot of my clients start to buy properties in other states, and that way they can rent them out, short-term or long-term rentals, and they can also use them when they want to.
Mm-hmm.
So I mean,
And
on your tax return, you are limited to your your first and second home if you have those.
mhm.
But if you turn it into an investment and you have multiple, at that point, it definitely benefits you more, turning those into rentals.
Yeah, now you mentioned having the properties in an LLC or an S-corp or something. What's best? And it seems like years ago people were talking about putting each property in a trust. So what's best?
Well, I mean, it depends on what do you want to. The trusts are more difficult because usually people would put them into a trust when it's going to be like a family investment. So we would see a lot of that. People were making trust if they had an inheritance that they were going to give to somebody. They have kids and grandkids that they want to benefit this, and they really want to have a lot of properties to increase the family's equity. If you're just going to, most of my clients will start off with 2 or 3 properties, and then they get the home buying fever where everything looks like a great investment, and as the economies go up and down in different locations, they're purchasing property. um, the trust can be a little more difficult to do for if you are really thinking about expanding and going into different states. I would recommend creating one S-corp and then having LLCs branching off of that into each state.
Mm-hmm. And so each LLC would own the one property. Is that what you're
Right.
saying?
Or the state's properties.
Okay.
So, I mean, the LLC, we in California, you have to still pay a minimum tax per company that you open up. So if you have 4 properties and 4 LLCs, you're still paying a minimum tax per LLC.
Right.
So if we have one LLC per state, then you're limiting the amount of tax that you're going to pay.
Yeah.
And on a state level, because the state says in their write-up for becoming a corporation or an LLC, they tell you that you have to pay a minimum for having the privilege of doing business in the state of California.
Mm-hmm.
So that can get pretty costly if you have 3 or 4 different LLCs. You're paying an $800 minimum per, and it doesn't matter if you make any money in them whatsoever, you're still paying that.
Right.
So I would say have one LLC for that state with that properties in it.
Yeah. So I was talking to somebody the other day, and they had outlined that if you have a company that's an LLC and then you have an S corp that owns that LLC and owns 100% of the LLC, and you're paid from the corporation, that's much lower in taxes. And that is that kind of what you're getting at?
Exactly.
Okay.
Yeah. Yeah. Because then you're the property manager at that point.
Uh-huh.
And that doesn't mean you can't also hire a property manager. And there's so many different ways to set this up. But yes, ideally you would have an S corp as the main company, the main owner for any LLCs that you were to open.
Right. Interesting. I like that. And then you're not capped at the 10,000 or the 12.2.
Exactly. Right.
Nice.
So if you're going to have more than one company, I mean more than one property, real estate, then that's the way to do it. If you're just looking at, you're 25 years old, just got married, want a place to settle down and have kids, then still it's a really good investment to own a home rather than renting, because when you're renting, you don't know if the owner of the property is going to sell it, and what's going to happen to you then.
Right. Or increase the rent every year or whatever. Yeah. Yeah. All you get's 30 days. So any final thoughts on that segment? And then I want to walk you through something, a little something different. You got any final thoughts on that little part?
No, what actually I do one more thing, and I think we are going to talk about that later in the presentation, is that right now with COVID, so many people are behind on their rent or their mortgage. The mortgage company, and I know right now, technically they're not supposed to evict you when you're a renter, but COVID aside, if you fall behind on your rent, they can quickly act on it. If you're falling behind on your mortgage, I've seen many mortgage companies wait. You have 3-4 months before they'll start really pestering you for that, whereas the landlord's not going to do that.
Sure. And an amazing fact, I had a client that actually got away with staying in their home for 7 years with no payments. Do you believe
Right.
that? I was amazed.
Yeah, I've seen that too.
Obviously, I couldn't get her a loan, but that's
Right.
right. Yeah. Okay, so you know, I think during the introduction, I had commented a little bit about a retirement mortgage or a reverse mortgage. So, of course, for those that don't know, 62 years of age or more, a person can get a reverse mortgage on their property, which is a loan that they do not have to make payments on, but interest does accrue. Is since they're not actually paying that interest out, can they not use that as a deduction, or can they?
They cannot.
Okay,
So it's anything that you're making payments on. So it can accrue forever, but if you're not paying on it, then you can only write off the dollar amount that you paid in that calendar year.
gotcha.
So for example, your client who didn't make a payment on their mortgage, they these were still accruing interest,
Yeah,
but since they hadn't made a payment on it, then they were unable to write it off. The same thing with reverse mortgage is it's only the interest that you are paying. And when you get reverse mortgages, that's not the idea behind that.
right. So when the homeowner passes and the property is inherited by the heirs, they refinance it, pay it off. All the interest that they paid, would they be able to deduct that?
Yes.
Yeah, okay. Interesting. All right. So now this is a bit of a surprise one, and yeah, I gave you a little heads up on it, fortunately, because I just wanted to throw it in there. Um, So I'm curious about your perspective on this. So 8.6% of current mortgages, national mortgages, are in forbearance. That's just under $1 trillion. And as mentioned, COVID is not recovering. Actually, there was a new spike about 10 days ago, and the report from John Hopkins said there was over 54,000 new cases in America. So with that many people in forbearance, nearly $1 trillion, and people aren't going back to work, Angela, what do you think that's going to do to the real estate market?
I mean, I feel like right now, well, you're the expert in the realty side of it. I have heard from a lot of my real estate clients that there are buyers out there right now. And, the people who are able to keep their jobs and make it through this as renters are seeing that they really want to start. People are tired of looking at their houses. So as a renter, I'm seeing a lot more people asking me about purchasing homes because right now they want to buy it. And there's more buyers I've seen than homes available right now to buy. I feel like right now with the forbearance, everybody's just kind of waiting to see what's going to happen. They're hoping that they're going to get a bailout from the mortgage companies and from the government. I think that with the forbearance, that a lot of the mortgage companies are going to end up putting whatever amount of payment that they have set aside for you, put that to the end of the loan, and everybody's going to start fresh with whichever month we're starting to get everything going again. But that's what I'm seeing from that point of view.
Yeah, you're absolutely right. There's definitely more buyers than there are sellers. I mean, there is not enough inventory, that's for sure,
Right.
and the prices continue to go up. Um, so so do unemployment rates. Numbers continue to go up, and the $600 care stimulus handout expires this month, I believe.
Yes, it does.
Right. So to me, not much of a recovery, an additional shutdown by Governor Newsom, and the $600 going away. I feel like it's going to get worse, and actually, um, I believe the last thing I read was nearly 30% of people that are not in forbearance that do have a mortgage are either paying short of the full amount or not paying at all. They're simply
Right.
not in forbearance. So with the $600 care act going away, we're not getting back to work. All these kinds of things. Gosh, I could see that trillion being tripled of people that are in trouble. Think there could be big foreclosure part of the economy coming up here in a year.
I think there could be, but I also feel like that everybody's going to try to help out as much as they can. So, I mean, with the loan companies, with all loans, credit cards, car loans, they're really giving people a chance to recover from this. I think that we are going to see a spike in foreclosures and in bankruptcies. I
Mm,
mean, the people just, I mean, the small businesses who are getting these loans, and they're going to get these loans and then still shut their doors because they're unable to open.
yeah.
And that is going to trickle down into their personal lives. And I mean, we're going to probably going to try to see a lot more short sales also.
Hmm. Yeah, I can see that as well. Well, it's a tough time for everyone, and gosh, it is nice to know that there's some interest that we can write off on properties. Certainly nice to know that it's a good investment, much better than renting. Um, Final thoughts.
So one more thing I would like to mention is when people, so everybody is trying to, they're tired of their homes, right? Everybody's been in lockdown. Home Depot's been crazy. Contractors have been crazy, just trying to do home improvements on the properties that people do have. One thing to keep in mind that a lot of people think they used to be able to get a home equity line.
Mhm.
If they were, they wanted to pay off credit cards or they wanted to do additions to the home. When you get a home equity line, it is not, the interest on it is not always deductible. So if you're using that to improve your property, you can write off the interest for it. But if you're taking out the equity in your home to pay off your bills, that is not tax deductible any longer.
Great point. So if you can show, if you're audited, that the proceeds from the home equity line of credit went to improve the property, like build an accessory unit behind or put in a pool or something like that, then you could write the interest off,
Yes.
limited to $10,000 with the interest on your first as well.
Well, the interest itself is not limited, but the property taxes are. So as we're making improvements on the home, if you're getting a permit, then your property taxes will increase because of the additional value you're putting into your home. So
Right.
yes, with the limit on it.
Gotcha.
And some of the improvements that we're making on the properties, um, if they are actual improvements, then when you're thinking about, because a lot of people when you buy a home, you want to add your own personal touch to it. You add a swimming pool or an addition to it. um, those generally, when you are renting the property, you can depreciate those. When you are, so over 39 years you can write it off. It's not an immediate write-off. When
Mhm.
you are when it's your own personal home, and that is your residence, any of those additions that you make, you can write off the interest for it, but you can't write off any of the repairs. I mean, I have a lot of clients who think that because they added a new roof, that they can just write it all off, and you cannot do that.
Not unless it's property, right?
Right. If it's a rental property and you're improving on it, then you have to depreciate the expense and the cost of that improvement. If you're making a repair, So for example, if you're getting a brand new roof on a rental property, you
Mhm.
have to depreciate that and expense it over 39 years. If
Mm.
you are making a repair on that roof, and it's not just a brand new roof, then that repair you can expense as a rental expense in that current year.
Mm. Yeah, so that would definitely go into deciding whether or not we're going to repair this for the next 20 years or put a new roof on.
Right.
Yeah,
And patch it up.
right. Well, all good information. I appreciate this, Angela, and